I'd like to welcome everybody to the July 2025 edition of NDSU Extension Agribusiness's Agricultural Market and Situation Outlook. Exciting things going on. We have a bit of a changed agenda today. Byron Parman usually kicks things off, has another commitment, but we'll be going through. We also have Ron Haugen speaking for a bit as well. But go ahead and kick things over to Frayne. As always, you can ask questions using the Q&A or chat tool, and we'll get to those at the end. But Frayne, the floor is yours.
All right. Thank you, Dave. Good afternoon, everybody. Frayne Olson. I'm the crop economist, marketing specialist with NDSU Extension. We're going to try and provide an update on some of the July USDA WASDE report, as well as some of the production report and the ending stocks report. So here's my contact information. If you do have any questions or anything later on that you want to visit about, I'd be happy to do that. As David said, we do have the chat tool available, as well as the Q&A function to be able to ask questions as we go through or later on as we end up our program here. So just to summarize, last Friday, USDA came out with a series of reports again, the WASDE report, which is the World Agricultural Supply and Demand Estimates, which is kind of that big summary information. Really was considered neutral for corn, soybeans, and wheat. There really wasn't a lot of changes from the June report into this July report. I'll talk about the refinements that we did see. Provide a little bit of an update on where we are with U.S. trade and tariff policy issues. That's obviously something that's evolving rapidly. I'll go through some more of the details of that and give you what we know as of today. And then just a reminder for everybody, August 1 is really the deadline for implementing these reciprocal tariffs that President Trump has been pushing for. So there have been a few extensions to that, but August 1 is now the current deadline. And so that's screaming up on us very, very quickly. And there are some progress being made, but there's still a lot of uncertainty. And just final reminder, as we talk about the trade and in particular the tariff issues, just to remind everybody, agriculture is important to these trade negotiations. It's always part of the discussion, but it's not necessarily the core or primary focus. So again, it is part of the issue, but it's not necessarily the centerpiece for all of the discussions going on. So just a real quick update on where we're at. So we get updates on both the old crop and the new crop ending stocks. So this would be for old crop corn and soybeans. The old crop wheat marketing year is ended as of June 1, and so now we're starting on the new crop wheat. So the old crop corn and soybean numbers, so I'm going to just highlight or separate the blue line on the very top, which is what the trade was expecting to see, versus the red line on the bottom, which is what the actual July WASDE report came out. The highlighted in black is from last month, so you can make some comparisons. So the issue really that the market is focused on, any kind of price response we get, is comparing the blue line, which is what they were expecting to see, versus the red line, which is what they actually got. And so on the corn side, we were looking at a slight reduction in ending stocks, which was positive for corn. As we look at what the changes were, just very quickly, the feed number was reduced a little bit from the previous report in June, but the exports number were increased again. And so USDA is really catching up on some of the more rapid export pace that we had throughout this growing season for old crop corn. The soybean numbers, really no change in the soybean number, and we weren't expecting much of a change either. Moving on to new crop. Now, new crop, we did get some updates, some minor updates. Obviously, the information from the old crop numbers gets rolled into the new crop numbers. Again, I'm going to compare the blue line on top, which is what the trade was expecting to see, versus the red line in the bottom, which is what we actually got in the report. So for wheat, there's really no substantial changes in the ending stocks forecasts. For corn, there was actually a reduction. The trade was, if you notice, between the black and the blue, the trade was expecting to see a reduction, but that reduction was a little bit more than they had anticipated or expected. Again, some would say that that was slightly positive for corn. So if you look strictly at the numbers, that's true, but I think the market was also looking at forward into what the actual yield numbers are going to be, and those I'll talk about in just a minute. So when it comes to the formal USDA numbers, very small changes there. Really, part of the reduction in this was a small reduction in planted acreage for corn. We did get at the end of June the June prospective plantings report, or excuse me, the June acreage report, which is the follow-on to the prospective plantings report. So the translation is very small changes to the corn numbers. Those changes were really anticipated. When we look at soybeans, a similar thing. We were expecting a slight increase in the soybean ending stocks numbers, and we did get those. Again, nothing really substantial, other than some small adjustments along the way. One thing to note, and this is impacting the corn market, is from the South American crop. The South American, the Brazilian corn crop, if you notice, everything stayed the same for our expectations for total production. Now, this would be the crop that Brazil is just finishing harvesting now. We were expecting, the trade was expecting a slight increase in the corn number, which we got. That is primarily the size of the safrinha corn crop. So that second crop corn, which will be harvested now shortly, that accounts for about 75% of Brazil's total corn production. That corn crop looks very, very large, and actually some private estimates looking at numbers much larger than the 132 numbers. So that is something that is weighing a little bit on the corn market as well. We also got an update in the wheat production numbers. So we got an update in the production report. The update for the spring wheat is starting to have some farmer survey numbers come in. The winter wheat is from farmer survey numbers as well as some actual harvest reports. So again, not major changes when you look at all wheat. The trade was expecting a slight decrease. We actually got a slight increase. Most of that was primarily from the white wheat numbers and also a little bit in the other spring wheat category. So this would be our spring wheat that we grow in North Dakota, Montana, and Minnesota. And again, some of that was a slight increase in the yield expectations for our spring wheat crop. Moving on then to corn and soybeans. Again, this would be new crop corn and soybeans. The only real change we got was a small reduction in the planted acreage for corn, which we got at the end of June. There's really no change in the soybean numbers. Now, just as a comment and an observation, in August will be the first month that USDA historically has updated any kind of yield projections for corn and soybeans. So the August production numbers and the August WASDE report are going to be watched much more carefully than they were here in July. So again, the only changes we got is from basically updating the data that we got from previous surveys. So update on negotiations on trade. Now, the European Union, we'll start there. They moved from a proposed 25% tariff to a 30% tariff. This includes a 50% tariff on steel and aluminum. Right now, today, there's some high-level negotiations going on in Washington, D.C. A lot of the European Union trade representatives are in Washington, D.C. right now talking to U.S. officials. We're not really sure or clear about how those negotiations are going. They're very, very tight-lipped. Of the information that we do have, it sounds as though they're moving forward. They are making a progress. They have a few more days to try and get to that August 1 deadline. For India, the only comment that we've had in the press is that an agreement is very close. So again, differing opinions about whether we're going to get a trade agreement with India or not, but it does look like right now there's more of a positive tone and getting some kind of general consensus. Indonesia, which is one of those growing markets for a lot of U.S. agricultural products, they have reached an agreement. Now, again, that's not a formal trade agreement, but it is an agreement on principle, and it's enough to be able to keep the U.S. tariffs at a much lower level. So they were reduced from a 32% initial number down to the 19%, which is currently in place. Indonesia has also then promised to purchase 50 Boeing airplanes, about $15 billion in U.S. energy products, and about $4.5 billion in farm products. Now, we don't know what those farm products include, whether they were detailed or whether it's just a generic agricultural purchases question. So more information to come when it comes to Indonesia. For Thailand and South Korea, again, two very important trading partners for us, especially in the wheat area. Negotiations are continuing. The current tone is it sounds like an agreement is possible by August 1, but the comments are much more cautious with respect to Thailand and Korea. Japan, there's high-level negotiations are continuing right now. The Japanese tariffs will move from 20 to 25%. So the 25% currently on the table is in an updated number. And the other thing that Japan has said, yes, they do want an agreement, in particular on automobiles, but they also said very bluntly that we will not compromise on certain elements. And I know rice is one of those areas that the Japanese are very, very firm on. The Trump administration is pushing very hard to allow U.S. rice into the Japanese market. So we'll see how that turns out. For Mexico, again, the tariff rates were increased. They went from 25% to 30%, and that's on all non-USMCA or the U.S.-Mexico-Canada Agreement products, and 50% on steel and aluminum. Now, Mexico so far has not retaliated against U.S. agricultural products as part of these negotiations or as part of the reciprocal tariff systems. But I know that negotiations are going on, and again, they're getting to be a little bit more tense now, both for Mexico as well as Canada. The Canadians, the tariffs went from a 25% rate to a 35% rate recently. And again, that's on all non-USMCA Canadian products. There's a 10% import tariff on Canadian crude oil and a 50% on steel and aluminum. Now, the negotiations with Canada are becoming much more tense. There's still obviously opportunity for an agreement. Both Canada and Mexico are very good trading partners with us. The USMCA is also that base trade agreement that we have in place. And so we're really negotiating on the margin when it comes to some of these additional issues. One more piece of news that came in the marketplace here recently is that Canada and Mexico independently, those two bilateral countries, are starting to strengthen their trade relationships in addition to the USMCA. And so there's some concerns about, that are some issues about will Canada and Mexico start to coordinate their negotiations against the United States? We don't know yet. And finally, just a real quick update on China. China issues or negotiations have really not been in the news very often over the last several weeks, primarily because of the focus on the August 1 deadline. The deadline for negotiations with China is actually August 12th, which is a little bit later. I know those negotiations are going on. There was an agreement in framework or agreement in principle, if you will, several months ago in Geneva. They're still trying to get President Xi and President Trump together for direct negotiations to try and see if they can come up with some kind of agreement. And I did detail that for U.S. imports of Chinese products are currently tariffed at 55% versus the Chinese imports of U.S. products at 10%. Now, there was also an agreement made on these rare earth metals and the magnet curbs. They were eliminated, and so we are making some progress with the Chinese, but we'll have to wait to see exactly how that plays out. And again, right now, the pressure is really on all of the other trade agreements given the August 1 deadline. Very quick update on some of the crop growing conditions. Drought monitor maps have actually improved. If you were to follow this over the last several months, this area, especially in Nebraska, southern South Dakota, and even parts into Kansas, that has actually been shrinking. The drought regions up here in North Dakota have stayed about the same as what they have been. When you look at the central part of, or the Corn Belt portion of the U.S., weather conditions have been nearly ideal. And so that's also weighing on the marketplace, in particular for the corn market. The expectation is not only, again, from a very large safrinha crop out of Brazil, which will add competition for our U.S. corn in the global marketplace, but also the potential for an above average or above trend line yield yield coming for U.S. corn. So again, we're getting close to this late July into the August timeframe when we start looking at pollination and flowering for soybeans. And so the next couple of months, we're going to be very, very critical from a weather standpoint. So the 6 to 10 day forecast for temperatures are above average in most of the central Midwest portion. That could put some stress onto the corn and soybean crop. I'm not anticipating that there be any major changes in yield expectations yet, simply because it looks as though that there's going to be adequate water. Rainfall right now has been normal to slightly above normal. The forecast is, at least for Iowa, Illinois, Indiana, Ohio, and even eastern Nebraska, to have a above average or better probability of average to above average rainfall. In our region, it looks like it will be not quite as warm. It will be average to slightly above average, but looks like we're having an above average probability for rainfall, which is really good. So for those areas that are in the northern tier of North Dakota, hopefully they'll be able to get some rain showers and to stabilize the crop conditions. So with that, I will stop sharing. And I'll be looking forward to any questions people might have at the very end. So I'll hand things over to Tim Petry.
Good afternoon, everybody. Tim Petry, Extension Livestock Marketing Economist. Go through kind of the similar slides that I always do, concentrating on cattle. So I know this sounds like a broken record that I've talked for several months, but the cattle market continues marching along at or near record levels, supported, first of all, obviously, by short supplies. The beef cow herders went down 6 straight years, and was going to mention this at the end, but I might forget. So while I'm thinking about it, USDA is going to issue their mid-year cattle inventory report that they did not do last year because of budget reasons, and they are going to do it this year. The problem is they didn't do it last year, so usually we compare this year with last year to see changes, so we don't have a last year to compare to, but at least we'll, get an indication of numbers and, maybe a little bit on replacement heifers or something there. So that comes out July 25th. If you're interested, at 2 in the afternoon, and my next webinar, I'll cover that in depth. So looking then at starting off with fed cattle like we usually do. Fed cattle last week were, very near record levels. A record high was back the week of June 13th, 9th to the 13th. And on a live basis, 239, just a little off. It went down for a couple weeks, then back up last week to 238, only a dollar off the record. And then if you look at the futures market, those red bars up there, the futures market is indicating maybe some lower prices by fall. And I certainly do agree with that. And that's one thing I want to talk about with all our market classes, or just about all of them, is usually this time of the year we do see peak prices and then go down seasonally into the fall. And, the light blue line there is last year. And, right about now, again, we were at the high for the year and we went down, and we'll see the same thing on calf price and so on. So again, what I kind of want to mention there is that, there's no conspiracy. That isn't USDA is wrong on their numbers, and when they come out on July 25th, or it isn't any other conspiracy to lower the market. That's a seasonal thing. Demand, as we'll see in a minute, demand for beef does fall off, and now that all the buying for all the holidays, the 4th of July and Father's Day and Memorial Day and all those, and the barbecuing season, all that buying is over with, it does fall off. And I better wait on that to my next slide. And so there's some seasonal weakness. We'll be at record high levels, and unless something drastic happens. But I know last year when the market started going down, and we'll look at the same thing for calves, I get calls and so on. Why is it when we're so short of supply that the market's going down? Just be aware that is a normal seasonal thing. It's all supply and demand related, and it isn't a conspiracy. USDA in the last WASDE report is forecasting an average of 221 this year for fed cattle, and certainly as of now looks like we will meet that. And for 2026, they're even going higher at 228. And so, keep in mind when USDA does these estimates, is as of everything is as at the present time. So, there wouldn't be any big tariff changes or other things like that. So we're at near record high now. Looks like seasonal will go down, and of course the big things that affect calf prices are fed cattle prices, particularly in those distant futures when, next year they would finish out. And, there's some risk off next year in those gold bars and futures showing possibly, after the first half of the year, which are a little above the same. But again, that's a long, long way off, and a lot of things can happen. But the Chicago is just a little risk off there. So, the basic thing is there we're at record high levels, which certainly supports the calf market. Now more on demand. Here's the beef cutout value, and this is a good proxy of demand because this is what packers can sell beef for into, both the domestic market and the export market. And so you see there again, up until a week ago, we were up there at record high levels, peak at 394 there, and even on a day basis or so, we did get above 400. But anyway, we did back off last week, and again, that is a normal occurrence. Beef, as you see, and look at the years below, that the beef cutout value usually does fall again because there's some slack in consumer demand, even though we have short supplies and so on. There is that. So we were down to 386 on an average last week. This week we're going to be off. This morning's cutout value was already down to 372, so we're probably for this week going to average 378. Just a normal occurrence of going down there. So just keep in mind, again, no conspiracy there. And that's why fed cattle seasonally are probably going to go down as well, because the cutout value is going down, and that's what packers can sell beef for, and therefore they will need to pay less for the steers that they buy. Still, however, we're at record high levels there, and at least for those selling very favorable prices. And another thing, a question that keeps coming up is how can consumers pay these high prices? Because we had record high prices for all the wholesale cuts, all the steaks, the primals and so on this spring. And one of the things that supply is easy to identify. USDA like we know what the cutout value is today and so on, but demand is more difficult to measure. But one of the things that some of the demand people that are surveying or so on says that there is a movement away from eating the high-priced beef, the steaks and so on in restaurants, more to eating them at home. You can buy a steak at the local meat shop or your retail store or whatever. Restaurants have to charge for their labor and everything else, and that all goes in. And so, steaks can be pretty high at a restaurant, but you can buy them and cook them yourself the way you want, and buy a local or whatever you might want to do, and at maybe a third of the price. So there's a movement to that of a lot of at home cooking of steaks, and it still fits into the budget and would be cheaper than going to a restaurant. I want to, Frayne updated you on the tariff situation, so I want to do a quick update on that. Again, on the upper left-hand corner are our major beef customers on a dollar basis, and he kind of mentioned all these countries that we're in negotiation with. In the case of Korea and Japan, both, we have a trade agreement with them that was negotiated in the previous Trump administration. And so beef, as of now, is still moving there very well. And in fact, in Korea, we'll look at the main numbers in a minute that just came out early this week, but exports to Korea were actually up double digits in May over last year, and Japan was up a little bit. Mexico and Canada off slightly, but just kind of pocket change. But the big one where we lost market share is China, our number 3 customer. So go over to the right-hand side. Here's our beef exports on a volume basis. And so kind of interesting, the red line is this year, and the light blue line is last year. So through March, even though we have less beef to sell, beef production is down. Well, so far this year, I'm thinking about 4% or so. Our exports were the same, but then you see a big fall off in April and May. And that big April and May fall off was due all to China. Go down to the bottom left. You see all of a sudden by April, exports to China off dramatically, and again in May, and there's just a trickle in there now. That we did have 147% tariff into China, but then it was lowered in mid-May there to 57%. But still, China has not renewed the meat plants here in U.S. to ship, has not renewed that they can ship, and so really virtually no beef is going to China because they haven't renewed, and the 57% tariff would probably stop it anyway. So go to the right hand side then. The is the export value, not just the volume. And so interestingly enough, again, that red line in March, actually our value of exports was higher than last year. As you see above, the volume was the same, but with higher prices, our value is the same. So, we were doing very, very well in exports, but then again, it's the China the last China the last couple of months that have caused even our value to go down, although still we're doing very, very well with Korea and Japan. So switch to calf prices then, no surprise with Frayne just talked about corn prices, and I'll talk a little bit more about that in a minute. And fed cattle prices up at record high levels. The calf market is just zooming along there as well at record high levels. But again, I want to emphasize, look at those lines. Look at the blue line last year. After now, we started declining, and usually that middle of October is a seasonal low, or it depends on. Last year they went down a little earlier than normal, and that was because it was so dry down in the southern plains, and they had to move calves earlier. But we still see that low, and so I'm expecting calf prices to fall off seasonally like they always do from the levels. Now there are very, very few calves, virtually none of it. We don't have 550 to 6 weight calves even available in North Dakota right now, but still they're supported at record high levels as of now, unless some catastrophic event comes down. Again, the Mexican border is still closed because of the screwworm situation, and so we've got less of those. And there is a push by some of the feedlots in the southern plains to try to get that back open, but it was closed all the way up until from last November up until spring, opened up for a little while there, and now screwworm did move north into Mexico, so shut again. So I'm thinking that that's probably going to remain. So anyway, there's calf prices at record high levels, but again, they're likely gonna go down, so just keep that in mind. This is the time of the year then when we start watching, we don't have any to sell in North Dakota at the present time, but we start looking at the video markets that price in calves for fall delivery and so on. And so the Superior Internet Auction had their first big sale of the season last week. They had almost 311,000 feeder cattle, as you see there in the middle, 310,992 feeder cattle, and most of them almost, the only that percent PO is the ones that pull out, that they don't accept. Most of them, the bids were accepted, but again, very good prices. I just pulled off on the bottom. There are some North Dakota calves. You see the cities they came from and so on, but these are some actual video sales of calves for fall delivery on the left-hand side, right off the cow and so on. So, at around $2,400 a calf. So again, pretty good levels. That top one there, 525 is bringing 454 would be 2384. You go down to those 180, 600 pounders at 415 is 2490. And so, that's, just at record high levels there and what they're getting. Another thing I just wanted to mention while I'm thinking about it now is there was a change in LRP before in the previous years. In order to do LRP, you had to have the cattle on hand, but there's a recent change in LRP here as of July 1st that the buyers of these calves can, even though they don't have physical ownership of them, they've already committed and put money down. So now that they can do LRP on the calves as well, if you are one that do buy that have bought some of these for backgrounding in the fall and so on. So again, the same story on the heavier weight yearling prices just keep marching on as fed cattle go up and so on and so on. So up at record high levels for them as well. And the futures market is a little off from our current cash prices here in North Dakota, but keep in mind that we do have a positive basis. Right now, the cash settlement price, I think, is about 322, and we're at 336 here on the average, even though we don't have hardly any to sell right now. So, as of now, the futures market is, we're well above last year's prices and so on, kind of similar to fed cattle. So, the futures market has just been marching along all year, up, although we do have some setbacks once in a while when announcement happens and the market is jittery. We've had some big movements, $3, $4, $5 even sometimes, one day up and the next day down and the next day up and so on. But the futures market today up there at right around 325. The last I looked is just at contract highs, but again, looking at the seasonal thing, that if they do start going down a little bit, that would be a normal thing. One of the things we haven't talked about much, and looking at feeder cattle, and Frayne, of course, has talked about this, is it's not only short supplies of cattle that have caused strength in feeder cattle as well, but it's corn going down. Here's the September corn futures and the August feeder cattle futures, and you see the opposite relationship there. And Frayne talked about the good growing conditions in corn and so on. So another thing that could affect feeder cattle, obviously, is if there were corn belt issues, which it doesn't look like now because of that opposite relationship. But just kind of again, change corn 10 cents a bushel, change calf prices $1 in the opposite direction. So far things positive there. But again, we've got a volatile market, geopolitics. We don't know, with trade and, weather and so on. So I think particularly when we get to the backgrounding here, it'll just be in a couple months where you're putting in the highest calves ever into a backgrounding program, and at the mercy when you sell them in March or April or whatever. I'm still thinking maybe some price risk management with setting a floor price and letting the top side open like an LRP or an option might be something to consider. So just, I usually talk a little bit about the lamb market, and again, very uneventful there. The blue line last year, red line this year, just following exactly. But again, usually there is seasonal weakness in lambs as we go into fall, just like there is in cattle. So don't be surprised if that happens, but just kind of mirroring last year as we go along there. So with that, stop sharing and turn it over to Ron.
Very good. I am going to talk about the reconciliation bill that was recently passed by Congress. There's a lot of things in here. People are still digging into things. And then a lot of the stuff needs to be kind of fine-tuned by the agencies and getting all the regulations figured out. but this is kind of what we know at this point. A lot of questions, people, what's in that bill, and people are digging into it. First of all, they put pieces of the farm bill in this big reconciliation bill. So we really didn't have a farm bill. It's, as we know, the farm bill is 2 years overdue from when they were going to renew it. There's been repeated calls for some extra support because of the prices have dipped here in the last few years. It is quite unprecedented that this bill, it actually cut quite a bit of the food assistance and then increase some of the payments to farmers. And normally the farm bill would have the food assistance and the farm associated farm increases in the same bill. So this is something that's really hasn't ever happened before. You can agree or not agree of what you think about the cuts to the food assistance, but it is unprecedented. As an overview here, 120 billion in budget cuts over the next 10 years for agriculture and food programs. And a lot of that then was the food assistance part, about 186 billion. And they increased the farm supports by 62 billion, and then about 4 billion for other programs. One thing that was hidden away in the bill was that actually it doubles the funding for USDA's trade promotion programs. I thought that was kind of interesting. There's immediate provisions that will go into effect right away. For covered commodities, the new law makes changes immediately for the 2025 to 31 crop years. Okay, so that's kind of like a 5-year farm bill then, the way if it would have been passed. It increases the PLC and the ARC and commodity marketing loans, and that's kind of what the ag groups were pushing for. It also makes a change to the payment limit and eligibility rules right away for the 2025 crop year. Also, next year in 2026, it provides a mechanism to update for new base acres as well. So first, let's get into the reference price increases on the PLC. Now, they vary by crop. They increase from 10 to 20%. I know when they were working on a farm bill a year or so ago, the House had one view, the Senate had another view, and so they must have had to come to some kind of a compromise here. But for example, corn has a statutory rate of 370 a bushel, and they moved that to 410. But as we know, we have an effective reference price, and it moves up with the market. And the market formula used a figure of 85%. They move that to 88%. So that kind of brings it up a little more. So the calculation moves then for 2025, it would actually move that from 426 to 442 a bushel, which is quite a good increase for the corn PLC. Reference of prices for soybeans also will increase from 966 to 1150. The effective reference price for wheat moves from 556 to 636. Now, these are the effective reference prices with the calculations done. And the statutory reference prices, they will increase automatically, and they'll be tied to inflation after 2032. Now we have some ARC increases as well. Before, the guarantee was 86% of your benchmark. They raised that to 90%. So you have a better guarantee. The guarantee was the moving average yield times the moving average price. And they also had a cap on the guarantee. The maximum payment you could get was 10%. They raised that to 12% now. So getting into all the nitty-gritty details here. Now, farmers ask, well, what's going to happen for this current year? Okay, because producers signed up this spring in March to go in, or actually it was in April, to go into the PLC or ARC, depending on the situations that they knew at the time. But now everything seems to have changed. Well, you will not be required to re-enroll or change your decision for 2025. Instead, the program will just pay the higher payment, whether it be ARC or PLC, okay, for the 2025 crop year. Then in 2026, it reverts to the annual enrollment decision for ARC or PLC again. So we have to make that decision again every year. So there was some changes for crop insurance. This actually surprised me because I all the information I had looked at thought I guess I thought they were kind of tamping down some of the crop insurance, but no, they had premium subsidy levels increasing from 3 to 5%. Okay, so as a result, then your buy-up coverage it changes it from 38 to 64%. It'll actually go from 41 to 69%, depending on your coverage level and the various crops and how much you want to buy up to. Also, the SCO, the supplemental coverage option for insurance, that was at 86%. That got increased to 90%. So that's quite the coverage level, 90%. There is some livestock provisions that I'm going to point out here. One of them is on the LIP. They will receive 100% indemnities for livestock's loss to predation and 75% compensation for animals lost to weather events or disease. And one thing that's new here, indemnities will also be available for losses for unborn livestock. Before the calf had to be born to collect for a loss. There also has been a dairy margin coverage increase to cover up to 6 million pounds of milk produced. This is just a couple things, bullet points that I pulled out. There's a lot of things in this bill that needs to be ironed out, and there needs to be guidance from the agencies on this as well. As I mentioned before, the payment limits are going to increase from it always was 125,000 for many years. And now they're going to raise that to 155,000. So that will be 310,000 for a married couple. And then that will be also going up with an inflation adjustment. The bill eliminates the income caps for farmers or entities that draw at least 75% of their income from agriculture or forestry. There's other provisions. Some of you are familiar with the LFP, the Livestock Forage Disaster Program. Okay, before you had to have to get a 1 month payment, you had to be in the D2 drought for 8 consecutive weeks during the growing season. They actually changed that now, so you get a one month payment for 4 consecutive weeks and a 2 month payment for any any payment or any time that you get D2 in 7 of the 8 consecutive weeks. So that was a little change that we happened to dig out. There's a lot of other things that may have been touched in this bill that I'm not pointing out today. It's just a matter of digging this out of the bill. It's a massive bill with a lot of information. And typically, there's other things that the Farm Bill addresses that didn't get put into this bill. Some legislators are talking about what they call a skinny Farm Bill, to kind of put some of the things in that are traditionally in a Farm Bill that really didn't get put into this reconciliation. We'll see what happens there. Now, there was also some tax things that are a part of this bill as well that'll affect farmers and other businesses. They changed, which we all thought this was going to happen. They actually changed the bonus depreciation back to 100%. It was phasing down for 2025. It would have been only 40%, but they bumped it back to January of 2025. You can still use 100% bonus depreciation for equipment purchases, and they made it permanent. Well, nothing's really permanent until they change it, but at this point, it's called permanent. There's a new special depreciation allowance that goes along with that 100% depreciation for non-residential rental property. And now the lawyers and accountants are digging into this, and the IRS will have to weigh in on this too. What does that mean? Does that mean it could be for other agricultural buildings or chemical buildings? We don't know yet, but that's what they're thinking. The bill also increases the 179 deduction to 2.5 million. And then and that you're capped up at $4 million of purchases. The QBID, the qualified interest income deduction remains. They made that permanent. Those are mainly for sole proprietors, and the pass through is affected as well. There is the business interest deduction limit. The Act permanently restores the provision, commuting your interest deduction. There's also something in here that it's kind of unique. Rural bankers will receive a 25% deduction on interest income from qualified real estate loans. So that's something that was put in. Also on estate taxes and capital gains. The estate tax exemption was made permanent. So they put it at $15 million per individual or $30 million per couple, and that will be indexed for inflation after 2026. And there was a new thing in here called the farmland sales deferral that allows landowners selling farmland to another qualified farmer. Well, we don't know really what the definition of a qualified farmer, whether it's a beginning farmer or what it is yet at this point. But you can defer capital gains over 4 annual installments. And this was to incentivize the selling of farmland to active, engaged farmers. A lot of people that know they're going to owe a lot of capital gains taxes may want to just wait until they die and get the stepped up basis, and it would go to their heirs. But this allows them to sell it before and get a break on the capital gains. So we'll see. I'm sure the IRS will have more guidance on that as we go too. So those are some of the bullet points that I pulled out for you to think about on this new reconciliation bill, and I'll entertain some questions at the end.
Yeah, so like Ron, I'm going to focus on the recently passed. I refer to it as one big beautiful bill, since it is the name of it. It has a little bit more swagger than most laws passed. But anyways, Ron did a great job covering farm programs, and I'm going to speak a little bit about some energy, and then consequently some biofuel programs that were impacted by the new law. Actually going to start with clean electricity production and investment. And so there's been a production tax credit and an investment tax credit for wind, solar, and other clean electricity for quite some time. Wind and solar specifically is going to be phased out quite quickly. So a project would have to have been, construction had to have begun by the end of this calendar year. So any projects that aren't in the pipeline are likely not going to be rushed in the next few months. One of the things that I've noticed, and it might be something to take note of, is regularly hearing the use of the term renewable energy to refer specifically and limited to wind and solar. So the phrase might be something where the law is not supportive of renewable energy. But it is actually quite supportive of biofuels, as I'll talk about in a second. And of course, biofuels are renewable, as would be hydro and other energy sources. So if you hear that general term of renewable energy, you might want to pay a little attention to exactly what they're speaking about. Again, because recently it's been limited to wind and solar. Related more to the state of North Dakota and just a little bit to ag. 45Q, which is the carbon capture and use tax credit, saw what could be a significant change. And so what we saw for the use side of it, so this could be for enhanced oil recovery or other uses, an increase from $60 to $85 per ton of CO2. And so that would end up being the same $85 that you would get for storage, would be the same if you used it for oil recovery, natural gas recovery, materials building. There's a few different things that could be there. Pretty big change, and especially too thinking about implications of what that might mean. Of course, why would I just store it geologically if I can get even a small payment for using it for enhanced soil recovery or some other purpose? And then finally, the bigger, more important one to agriculture specifically is changes to 45Z. And I'll speak about those a little bit at length. So the changes specifically is we've seen the length of 45Z be extended from the end of 2027 to the end of 2029. We're no longer going to consider indirect land use change when calculating the carbon intensity of fuels, kind of in alignment in the spirit of other activities or announcements made. The 45Z will now limit eligible biofuel or clean fuels that are made with feedstock produced in the US, Canada, or Mexico. And again, in the case of biofuels, you can think about the crop itself, or products or co-products, vegetable oil, tallow, grease, those types of things. But again, beginning next year in 2026, it would have to be produced in one of these three places. And then also a big change, and probably the only one of these changes that could be perceived as negative, would be reducing the maximum credit for SAF from $1.75 to $1 per gallon. And so that's sustainable aviation fuel, which is a lot of interest in agriculture, in the corn ethanol industry, and here in the state with GEVO buying the Red Trail corn ethanol refinery, a change that reduces that maximum credit they could get. So what does this mean? With the program extension, we do have a number of biorefineries that have already gone through the process with the IRS, with others to participate. What we're missing, and been missing for the last 3 years, is the rules for feedstock production. Again, one of the unique things about 45Z is that it accounts for how a crop is produced and the carbon intensity of that crop, which is a major shift. And it's been 3 years that we've been waiting for rules on that we haven't received. And now we have another 2 years within the program where they could be used. As I mentioned, with indirect land use change, the big impact with that is, biofuels almost always have a negative land use change. And so that would be, there's emissions associated with land use change. Well, if we don't account for that anymore, the carbon footprint of biofuels, and I'm not going to say all, because there could certainly be an exception, but for practical purposes, the carbon intensity of all biofuels will now go down. And this is a big deal because of two reasons. The most important one is you have to be below a certain carbon intensity to receive any tax credit. And so this will put many biofuels right into the money, even before making any changes, either at the biorefinery level or in terms of how a crop was produced. And then it will also, if you achieve that level, any additional reductions will be a larger tax credit. And so that's a major shift in policy, appealing, more so to like corn ethanol, which the way 45Z was before, when you accounted for indirect land use change, they were kind of on the wrong side of that. You would have to make some pretty significant changes. Now that's really no longer the case. In terms of having North American feedstock production, that's a major change. Again, this will be the law beginning next year. So this really takes out used cooking oil, tallow, imports primarily, which have been coming primarily from Asia or South America. Again, it doesn't prohibit that you can do it, but if you use those feedstocks, you can't get this tax credit. And the tax credit of up to $1 a gallon is really substantial. The profit margins for many of the folks who import used cooking oil, tallow to make renewable diesel, that tax credit is a critical piece of remaining profitable. And then finally, just talking about the SAF credit reduction, nothing surprising in terms of what it means, but it would reduce the profitability of and the likelihood of there being investments in SAF. And that was already a kind of a challenging space to be before this, and this again would reduce that maximum credit that they could receive. A little bit of a heads up on what to watch for. Again, if and when 45Z is fully rolled out for production agriculture, it will have a significant immediate impact. But right now, we're still waiting for guidance regulation. Ron made mention of this during his talk. Until we get that guidance, this piece really doesn't take effect. We don't know which practices are going to be incentivized. We had a little bit of a hint of what the previous administration was thinking in a document. There's a lot of different options in terms of what could be used. There's a lot of evidence that supports things like changes in tillage and use of cover crops, nutrient management, and the like, but we don't know specifically what will be included, and we don't know how large the tax credits will be, and not really focusing on the tax credit, but what would the change in emissions be? And so if we don't know what the changes in emissions be, we don't know what the tax credits would be as well. We also don't know exactly how folks are supposed to document this, share it with others, and then be ready for an audit of whatever form. Makes a pretty big difference. Again, in order for a farmer to fully participate, we know they're going to have to do some of these things, but exactly what? And so how do we get ready for marketing corn, soybeans, canola that would end up being used by a biorefiner if we don't know exactly what they're asking for? And again, it could be something very small or it could be something elaborate. But right now, that uncertainty, and of course, right now, the inability to participate makes this really tough. Even if the rules come out, proposed rules came out, it would take, at least a month to finalize them. Typically, that's a process that will take, at least 90 days for rulemaking, comments, and then a final rule to be issued. So we're really kind of sitting and waiting, trying to figure out, what those proposed rules would be. In general, I take it as promising, again, because this bill was just passed into law, and it includes, it was penciled out, marked up at a considerable increase in spending, that there would be work by the administration to have some proposed rules out sometime in the near future, so that these benefits can be realized by producers. That ends my formal remarks, the formal presentations. As noted before, use the Q&A tool or the chat to ask questions. I would like to bring up, next month, we're actually going to kick back our scheduled webinar due to some existing travel conflicts. Also send out some additional information about that, and we'll likely have a reconfiguration of the webinar that will require you to re-register. We'll make sure we give you enough heads up and reminders so that you can do that. But with that, we're happy to move on to questions, and I know we have a few. And Frayne, if you want to grab the first couple, they kind of head your way.
Sure, yeah. So first question, let me scroll up just a little bit. Can you touch on the acreage in North Dakota that was hit by the severe weather in June, and if production will be hurt? Obviously, for those farmers that got crop damage or had damage to their property or their grain bins, their buildings, that was pretty significant. Based on the numbers that I have seen so far, it looks as though there's about 125,000 acres that have been impacted in the state from a crop standpoint. If you do the math on that, we have give or take about 25 million acres of cropland in North Dakota every year. So that would be about 0.5%. So that's a relatively small number from an aggregate standpoint across the entire state. So no, I really don't anticipate that we're going to have any yield adjustments or any major shifts due to the storms. And again, for the farmers that got hit, it's a big deal. It's definitely something that needs to be watched. but from an aggregate, from a marketing standpoint, relatively small. Another question is canola oil from Canada subject to the additional tariffs, or is that already part of the USMCA agreement? So both canola, the whole canola that goes across the border between the United States and Canada, as well as the canola oil, are covered under USMCA. So these additional tariffs that are being talked about are not part of that. So it shouldn't impact the flow of agricultural products across the border. The biggest, probably most important thing from a long-term standpoint would be any kind of steel or aluminum that came across from the Canadian side into the United States. So from an agricultural standpoint, relatively small. Another one, and I'll take the next one, and then it looks like Ron has a question. Any comments on the current trade war with Brazil? How could that affect U.S. farm businesses and consumers? So we do have some trade between the United States and Brazil. President Trump put an additional 50% tariff on Brazilian products coming in because of his concerns about some of the political issues going on in Brazil. The Brazilians retaliated with a 50% tariff on U.S. products. Now, the trade, we actually have a trade surplus with Brazil, which is, we buy more stuff from them than they buy from us. So, how that all plays out is kind of questionable. For agricultural trade, it's going to be relatively minor. We do import some Brazilian coffee and tea. There's also some sugar cane or refined sugar that comes into the United States from Brazil. They also, in reciprocate, buy a little bit of ethanol from the United States. We buy a little bit of ethanol from them. So there's some trade going on back and forth. But from an agricultural standpoint, relatively small. And again, when we usually think about Brazil, we're looking at Brazil as a major export competitor for us. So we're competing for the same market. So again, when we're selling our corn, we're selling our soybeans or our wheat into the international markets, we'll look to Brazil as one of our major competitors. So for direct trade between the United States and Brazil, I don't know that it's going to have a large impact. Again, unless you're dealing with some of the fruits and vegetables or some of the tea and coffee that might be imported from Brazil. So Ron, I'll let you take the next one.
Yeah, you were wondering about if you wanted me to restate the reference prices. No, this is the effective reference prices, not the statutory one. So corn was 442, and wheat was 636. Well, some sources say 635. It's probably due to rounding, I guess. And then soybeans 1150. So I don't have it for any of the other minor crops, but those are the major ones.
Okay, so next question, I guess I'll take this one again. Do you see China buying soybeans this fall? Wondering what forecast is on commodities. Will we see improvement in prices? So the soybean purchases by China is, U.S. for U.S. soybeans purchases our sales into the Chinese market. That's obviously one of those really big things hanging over the markets right now. So far, well, at this time of year right now, China typically buys very little soy from us to begin with. One of the things that I am looking for is starting probably in August, we will start to see China come in and make some purchases for fall delivery. So again, in the international markets, the buyers are usually thinking or planning anywhere from 2 to 6 months into the future. And so if you're living in China right now, you're a soybean crusher in China or an importer, you're looking for U.S. soybeans, you're probably thinking about switching some of those sales, getting something on the books. So I will be looking for any kind of 2025, 26 export sale announcements into China. They should be starting to appear probably in August. My personal bias is I do think China will come in and buy U.S. soybeans, but the big question is the volumes. And my suspicion is that the volume, the amount that they're going to purchase from the U.S. beginning the fall will be lower than it was last year. Not substantially lower, but will be lower simply because the Brazilians had such a very large soybean crop last year. So they have large volumes to be able to sell. They will be in exportable positions for an extended period of time now. The one question that might come up for some Chinese buyers would be the quality of the soybeans, because it's very difficult to store soybeans in Brazil, given their heat and humidity. So there usually is some quality deterioration later on in the season. So my best guess, just to summarize, I do think we'll start to see some Chinese purchases unless the trade issues really ramp up and get to be kind of silly levels like we saw before. But I don't think we're going to be able to sell as many soybeans into the Chinese market as we have the last couple of years.
Great. Thanks, Frayne. Yeah, and a couple of quick comments too. There's a question about canola oil from Canada, USMCA. I know I spoke about it likely in May, if not last month. The renewable fuel standard, the federal policy to support the use of biofuels, as part of the annual process to establish the mandated levels for the next year. So in May we heard proposals for 26 and 27, what those levels would be, which are actually quite a bit higher, which is supportive of biofuels and ag. But there was also the language about only getting half of a RIN if it was imported biofuel or imported feedstocks. And we do use quite a bit of canola oil-based biodiesel in the United States. And so that would have an impact on the markets. And then also, too, just talking about Brazil, across the news today, it appears that we're going to begin some conversations with Brazil. They do have a tariff on imports of ethanol. Theirs are 18%, ours are 2.5%, and we'll see how that goes. I know I spoke about that earlier this year too. It's an important issue, but also from the Brazilian standpoint, they view ethanol as sugar. This is just a different form of sugar, and they always like to bring up the U.S. sugar program when talking about ethanol. It'll be interesting to see how that conversation continues, and it does seem as if Brazil is going to take a rather secure posture when having these conversations. And I do know too, there's a lot of folks in Brazil who would love to see more affordable ethanol, especially at certain times of the year when prices are higher. And so it'll be interesting to see how that conversation takes place. I don't see any more questions. So with that, I'd like to thank all the other presenters, as well as everybody who joined us today, and especially those who asked questions. We will be back in August. Right now, we're scheduled for the 24th. And please be ready, on the lookout for a message or two in your emails about the re-registering for the webinars. It'll still be on Zoom, but we'll likely make a few updates which will require that. But with that, I hope everybody has a great rest of the day. And by the time we talk to you, summer in many respects will be over. So we'll see you in a few weeks.